Hello, this is Ma'am Buen again. Today we're going to discuss correction of error, a topic for auditing. So what is an error? An error are omissions and misstatement in the entity's financial statement arising from failure to use or misuse a reliable information. Examples, we have mathematical mistakes or say wrong footing. We have error in applying accounting policy. Example is when we purchase PPE and the transportation charges is 50,000, what should be the proper treatment of the transportation expense? It should be capitalized, but instead our client recorded it as transportation expense. So that is an error in applying accounting policy. Oversight or misinterpretation of facts and fraud. Example for oversight or misinterpretation is, say, the depreciation expense. We're not able to prepare depreciation expense at the end of accounting period, so that is also an error. We have prior period errors. So what is this prior period errors? Say, the current year which we are auditing is 2020, and during the course of our audit, the financial statement of 2020, we discover an error from prior years, which means that is errors of 2019 or 2018. Okay, so that is what we mean of prior period errors. These prior period errors can be counterbalancing error or non-counterbalancing error. What is this counterbalancing error? So, it is an error which, if not detected or corrected, will automatically corrected in the next accounting period. It means that, say we are auditing the current year, which is 2020, and there is an error in 2019. If it is not detected, automatically it will correct this year 2020. Okay, so what are those errors? We have the inventory, including purchases and sales. For inventory, overstatement, say again, our current year, the year that we are auditing is 2020. So in 2019, we have an overstatement of inventory of 100,000. So what will happen to our income of 2019? If an ending inventory is overstated, our net income is also overstated. So, for our net income of 2019, it is overstated by 100,000. Automatically, whatever is the ending inventory of 2019, automatically, that will be the beginning inventory of 2020. So, if our 2020 beginning inventory is overstated by 100,000, it means the net income of 2020 is understated by 100,000. So, that is what we mean of counterbalancing error. Again, if 2019 is overstated, and then the inventory of 2019 is overstated by 100,000, our net income is 100,000. And automatically, the following year, 2020, our net income is understated by 100,000. So, it correctedly, it is just, it automatically corrects their error. Okay, so that is inventory. Also purchases. Again, the beginning inventory and purchases are part of GAS. So let me repeat it again. If the ending inventory is overstated, automatically the income is also overstated. But if the beginning inventory or purchases, which means, or the GAS, goods available for sale, if the goods available for sale is overstated, the net income is understated. It is the reverse. Again, let me repeat it again. If the ending inventory is over, the net income is over, the same. But if GAS, goods available for sale, is over, the net income is the reverse, which is understated. Okay, so sales. What about sales? Example for sales. 2019. Again, we are auditing the current year, which is 2020. So there is a sale in 2019, an invoice dated December 31, 2019, and the goods were shipped, but these goods are FOB destination. Our client prepare an entry on December 31, 2019, debit AR and credit sales. But again, it is FOB destination. So, it means the income of 2019 is overstated because it should not be reported as sales of 2019. But since it were not recorded as sales of 2020, so the income of 2020 is understated. So it counterbalanced. It was automatically corrected. Okay, we have prepaid expense. Again, first is, what is a prepaid expense? It is an expense paid in advance and it is an asset. So, usually, if we said prepaid expense, remember, it means that this errors, it means that we were not able, or our client were not able to prepare an entry to record this 1, 2, 3, 4, 5. So, prepaid expense. Our client were not able to prepare an entry for prepaid expense at the end of the year. An adjusting entry. Remember, we have adjusting entry for prepaid expense, or we have two methods used in recording our prepaid expense. One is an asset method and the other one is an expense method. If we were not able, or our client were not able to prepare an adjusting entry to record prepaid expense, it means it is an expense method because the entry which were omitted to record the prepaid expense is debit, prepaid expense, and credit and expense. Okay, so let us have an example. Say, on October 1, for prepaid expense. October 1, 2019, 1 year rent expense. Let us make it simpler. For 12,000, which means that is 1,000 per month. Okay, so on October 1, 2019, a 1 year rent expense were paid for 12,000. So our entry, or the entry prepared on the transaction date October 1, is debit rent expense 12,000 and credit cash 12,000. Come December 31, 2019. December 31, 2019. There should be an adjusting entry that should be prepared, but it was not prepared. So that is what we mean of prepaid expense not recorded. Okay, so it was not prepared. So what will happen? It means that our expense were overstated because in the trial balance, the rent expense that will be reported is 12,000. But actually, it should be 3,000 only, October up to December. So it is overstated by 9,000. Okay? In that case, so again, what is the adjusting entry that were not recorded? It is debit prepaid rent and credit rent expense of 9,000. Again, because this entry were not prepared, our rent expense is overstated by 9,000. So what will happen to our income? It will be understated by 9,000. Come 2020, our client does not prepare any entry anymore for the 9,000 rent expense because there's no cash outflow in 2020. All the 12,000 were paid in 2019. So the rent expense of 2020, which is the 9,000, will not be recorded. So in that case, the net income or the rent expense first, the rent expense is understated by 9,000, which means the net income is overstated by 9,000. So again, it counterbalance the net income of 2019 and the net income 2019, which is understated by 9,000. Come 2020, the net income of 2020 is overstated by 9,000. Okay, so that is prepaid expense. We have accrued expense. What is an accrued expense? An accrued expense is an expense already paid but not yet, an expense already incurred but not yet paid. It is a liability. Again, accrued expense. So, omission of accrued expense, non-recording of accrued expense. And usually, what is the entry to record our accrued expense? That is debit expense and credit liability. Okay, example. December 31, we have an accrued salary. Accrued salary of, say, 30,000. And because it were not recorded in December 31, it means that our, by the way, what should be the adjusting entry that should be prepared to record this accrued salaries payable? That is debit salaries expense 30,000 and credit salaries payable of 30,000. Okay, again, this entry, this adjusting entry were not recorded. So, what is the effect of this to our net income? Our salaries expense is understated because it were not recorded, understated by 30,000, which means our net income is overstated by 30,000. Okay? Come 2020, when the company pays this 30,000, then an entry were prepared. Debit salaries expense of 30,000 and credit cash of 30,000. This time, our expense is overstated by 30,000, which means our income is understated by 30,000. So again, it counterbalanced. The income of 2019 is overstated by 30,000, then the income of 2020 is understated by 30,000. So it automatically corrected its error. Okay, so that is accrued expense. Then we have deferred income or unearned income. Again, for deferred income, we have two methods used in recording our deferred income or unearned income. Or first is, what is an unearned income? It is an income already received but not yet earned, or it is an advance payment received from customer. We were given already the payment, but we haven't delivered the services or merchandise yet. So it is a liability. We have two methods used in recording our unearned income. That is liability method, and the other one is income method. Okay. So again, we were not able to prepare an entry for deferred income or unearned income, and that is a liability. It means that income method were being used because the adjusting entry that we should prepare is debit income and credit unearned income. Okay, let us have an example. On September, this is unearned. The date is September 1. Received 12,000. Let us make it simple again. Received 12,000 from a lessee for rent income. Okay. So on September 1, our transaction or our client's transaction received 12,000 for a lease for rent income for 1 year. Okay. So the entry prepared is debit cash of 12,000 and credit rent income of 12,000. Okay, Come December 31, 2019, this is 2019. Come December 31, 2019, our client did not prepare an adjusting entry for this one. It means that the rent income reported in the income statement is 12,000, and that is wrong. Why? Because we only give or delivered 4 months, so the rent income should only be 4,000. It means that the income statement, the net income is overstated by 8,000 because, again, no entry were being prepared. And what is that entry that were not prepared? It is debit rent income and credit unearned rent income. It is a liability. We forget, or our client forget to record liability. So again, for income statement of 2019, net income is overstated by 8,000. Come 2020, since there's no inflow of cash in 2020, the 8,000 rent income will not be recorded because all these 12,000 were received in 2019. It means that in 2020, net income will be understated by 8,000. So again, it automatically corrected the net income of 2019, which is overstated by 8,000. This time in 2020, the net income is understated by 8,000. So automatically, our retained earnings at the end of 2020 will be correct. Okay, so that is an earned income. And we have accrued income. So what is an accrued income? An accrued income is an income already earned but not yet received. It is an accounts receivable. An example is an accounts receivable. Again, accrued income is an income already earned but not yet received. So it is an asset. And what is our adjusting entry? That is debit an asset and credit an income, which means that if it is an error, it means our client does not prepare or were not able to prepare an adjusting entry for that. And what is that adjusting entry? That is debit accounts receivable or debit and asset and credit income. Okay, so let us have an example. Say we have on December 31, 2019, we have an accrued interest income of 20,000. And this 20,000 were not recorded. Our client does not prepare an entry to record this. So it means that the 2019 net income is understated by 20,000. Come 2020, when we receive this interest income, then an entry were prepared, debit cash and credit interest income. But because of that, the net income of 2020 is overstated by 20,000. So again, our income, the income of 2019 is understated by 20. Come 2020, the income is overstated by 20,000. It means it automatically corrects the error. Okay, so that is our counterbalancing error. Again, we have inventory, we have prepaid expenses, we have accrued expense, we have deferred income, and we have accrued income. What about the non-counterbalancing errors? These are errors which, if not detected or corrected, will not automatically correct in the next accounting period, which means unless corrected, the financial statements will always be wrong. Example of this is our depreciation expense. Example, in year 2018, the depreciation expense were understated by 30,000. So Because of the understatement of expense, our net income is overstated. Come 2019, let us say that in 2019, we recorded correct depreciation expense. But it means that since the 2018 depreciation expense is understated, it means the net income is over. And 2020, it is still the same. Our financial statement is still wrong. Why? Because the retained earnings is still understated. And come 2020, it is still wrong because the retained earnings is understated. Okay. So, what are the other examples of non-counterbalancing errors? Say for prepaid expense. Again, for prepaid expense, we have two methods used. We have the expense method and we have the asset method. In this one, it is expense method. If it is asset method, it is a non-counterbalancing error. Because if it is asset method, when we prepare our entry on the transaction date, say our transaction, December 1, 2019, our transaction purchase office supplies, 30,000. And the entry prepared is debit office supplies, 30,000. And credit cash, 30,000. Come December 31 of 2019, there's still unused office supplies of 10,000. It means that 20,000 were being used or expensed, but there's no entry prepared for that. And because of that, by the way, what should be the adjusting entry that should be prepared on December 31? It should be debit office supplies expense of 20,000 and credit office supplies of 20,000. Because this entry were not prepared on December 31 of 2019, it means that the net income is overstated by 20,000. Why? Because the expense is understated because this entry were not prepared. So the expense is understated, the income is overstated. Okay, come 2020, there's no outflow of cash for office supplies for this 30,000. It means the other 10,000 which is used in 2020 were not recorded also. So again, in 2020, the net income is overstated because the office supplies expense is understated. Okay? So again, say in the following year, 2021, there is already the correct recording of expense. But just the same, our financial statements are still wrong. Why? Because our retained earnings is still overstated because this 30,000 were not recorded both in the financial statement of 2019 and 2020. That is why up to 2021 it is still wrong. Okay, so unless it is corrected, the financial statement will always be wrong. Okay, so that is our correction of errors. Let us have some illustrative problem. Zamanta Company reported the following net income. In 2019, it is 1,750,000. In 2020, it is 2 million. An examination of the accounting records for the year ended December 31, 2020 revealed that several errors were made. The following errors were discovered. We have salary accrued at year end was consistently omitted. In 2019, that is 100,000. In 2020, that is 140,000. The footings and extensions showed that the inventory on December 31, 2019 was understated by 190,000. We have prepaid insurance of 120,000 applicable to 2020 was expensed in 2019. Interest receivable of 20,000 was not recorded on December 31, 2020. On January 1, 2019, an equipment costing 400,000 was sold for 220,000. At the date of sale, the equipment had accumulated depreciation of 240,000. The cash received was recorded as miscellaneous income in 2019. Okay. In addition, depreciation was recorded for the equipment for 2019 and 2020 at the rate of 10%. The requirement, prepare working paper showing corrected net income for 2019 and 2020 and prepare adjusting entries on December 31, 2020, assuming that the books are still open, and letter B, assuming the books are already closed. Okay, so let us solve this problem. So we have our net income of 2019, we have 2020 of 2 million, and we have 2019 of 1,750,000. Okay, so this is our unadjusted net income. Okay, so the first info, an examination, oh, by the way, the current year is 2020. So, in this requirement, assuming the books are still open, it means the book of 2020. We are referring to the books of 2020. So, what we are auditing is the financial statement of 2020. So, again, an examination of the accounting records for the year ended December 31, 2020, revealed that several errors were made. The following errors were discovered. We have salaries accrued at year end was consistently omitted. That is, in 2019, 100,000, and in 2020, it is 140,000. Okay, so we have salaries expense, accrued salaries. So, unrecorded salaries payable. In 2019, and we have 2020. So, in 2019, it is 100,000 and 140,000 in 2020. So, we have 100,000 and 140,000. Okay. So, again, what is the adjusting entry that were not prepared? That is debit salaries expense and credit salaries payable of 100,000. Which means that if that entry were not prepared, our expenses were understated. So what happened to our income of 2019 if our expense is understated? That is overstated. So minus, it is overstated. Come 2020, this 100,000 were paid and the entry prepared in 2020 when we paid that 100,000 is debit salaries expense and credit cash, which means the expense is overstated and our net income is understated. So it is plus 100,000. Again, in 2019, this 100,000 were not recorded because the entry that should be prepared, debit salaries expense and credit salaries payable, were not prepared. So, it means our salaries expense is understated. That makes the income overstated. So, 100,000 minus 100,000. Come 2020, when this 100,000 were paid, the entry prepared by our client is debit salaries expense and credit cash 100,000, which makes our salaries expense overstated, and in effect the net income is understated. So plus 100,000. Okay, so for 2020 that is 140,000. So minus, because again our salaries expense is understated, which means the net income is overstated by 140,000. Okay, next, footings and extensions showed that the inventory in December 31, 2019 was understated by 190,000. So, understatement of 2019 ending inventory, and that is 190,000. Okay, 2019, so this is 190,000. Again, understatement of ending inventory. If the ending inventory is understated, our net income is also understated. I'm sorry, it should be add. So, again, if our ending inventory is understated, our net income is also understated. So, automatically, the beginning inventory of 2020 is understated, which means our net income is overstated by 190,000. Okay, over. This is understated. Okay, next. We have prepaid insurance of 120,000 applicable to 2020 was expense in 2019. Okay, so we have prepaid insurance applicable to 2020, expense in 2019. Okay, so that is, how much is that? That is 120,000. So 120. Okay. So again, prepaid insurance applicable to 2020 was expense in 2019. So that is 120,000. Okay. So expense in 2019, which means it was recorded as expense in 2019. So what is our it means that the expense of 2019 is overstated. So our net income of 2019 is understated by 120,000. Again, prepaid insurance applicable to 2020 was expense in 2019. So it was recorded as expense of 2019, which means our expense of 2019 is overstated. So our net income is understated. So it is plus. Come 2020, this should be reported as expense of 2020. But again, because there's no cash outflow in 2020, it were not recorded as expense. So it means that expense of 2020 is understated by 120,000. In effect, it overstates the net income by 120,000. Again, the expense of 2020 is understated by 120,000, which in effect, the net income is overstated by 120. So we have to deduct 120 because it is overstated. Okay. So we have interest receivable of 20,000 was not recorded on December 31, 2020. That is interest receivable. That is accrued income. Again, interest receivable of 20,000 was not recorded in December 31, 2020. So we have unrecorded interest receivable. That is 2020. How much again? That is 20,000. Okay, so 20,000 here because it is 2020. Again, what adjusting entry were not prepared in 2020 for this one? That is debit, interest receivable, and credit interest income. Okay, again, what is the adjusting entry that were not prepared in 2020, December 31, 2020? That is debit, interest receivable, and credit interest income, 20,000, which means the net income of 2020 is understated. So what are we going to do with this 20,000? That is plus 20,000. Okay. Then, On January 1, 2019, an equipment costing 400,000 was sold for 220,000. At the date of sale, the equipment had accumulated depreciation of 20,000. The cash received was recorded as miscellaneous income in 2019, and also depreciation was recorded for the equipment for 2019 and 2020 at the rate of 10%. Okay, so even if the equipment were already sold, still they prepare an adjusting entry for that, which is 10% of the equipment, which is 400,000. So that is 40,000. Okay. So first is, let us determine, let us prepare first the entries prepared by our client. Okay, again, January 1, 2019. So, on January 1, 2019, our client prepared, this is per client, debit cash and credit miscellaneous income. Okay. This one. The cash received was recorded as miscellaneous income. So, that is, how much is that? Was sold for 220,000. Again, the entry prepared per client is debit cash, 120,000, and credit miscellaneous income of 120,000. And what should be the correct entry? This one is the correct entry. It should be debit cash of 120,000. I'm sorry, it should be 220. Debit cash of 220,000. At the date of sale, the equipment had accumulated depreciation of 240. Another debit, accumulated depreciation of 240,000. 240. Then credit equipment of 400,000. And we have again, we have 460 debits. So, we have 60,000 difference in our entry. So, that is gain on sale of equipment. Okay. So, let us put it in our working paper. So, sale of equipment. That was in 2019. How much? That is 220,000. So again, the entry prepared by our client is debit cash and credit miscellaneous income 220, which means we have an overstatement of net income of 220,000 because this should not be recorded as in miscellaneous income. So we have 220,000 overstated. Okay. But take note, the entry prepared, the correct entry should be debit cash 220,000, debit accumulated depreciation 240, credit equipment of 400 and another credit, gain on sale of 60. The 60,000 were not recorded. So it means we have unrecorded gain on sale of 60,000. Since the 60,000 were not recorded, it means that our net income is understated. And we have the depreciation expense. Okay. In 2019, our client recorded debit depreciation expense and credit accumulated depreciation. That is 40,000. That is 10% of 400,000. And there should be no entry. The correct one is no entry because it were already disposed or retired. Come 2020, Another entry were prepared for depreciation expense, and that is the same, debit depreciation expense 40,000 and credit accumulated depreciation. And also 2020, that entry should not be prepared anymore. Okay, so let us put it here. And for 2019, we have 40,000. Also in 2020, we have 40,000. The entry, debit depreciation expense, 40,000, credit accumulated depreciation, 40,000, makes our depreciation or makes our expenses overstated. That means our income is understated. So, if it is understated, we have to increase or add 40,000. Same with 2020. We have overstatement of depreciation expense, which means our income is understated by 40,000. Okay, so we have to compute now. Okay, so how much is our adjusted net income? So for 2019, that is 1,750,000 plus minus 100,000. Then we have plus 190, plus 120, minus 220, plus 100. So that is 1,840,000. The correct net income of 2019 is 1,840,000. For 2020, we have 2 million plus 100,000 minus 140 minus 190 minus 120 plus 20 plus 40. So that is 1,710,000. Okay. So let us now prepare our adjusting entry. Audit adjusting entry. Assume the books are still open. So, AJE, audit adjusting entry, books are still open. It means that we can still use our nominal account. Okay. Remember what we're going to prepare our adjusting entry on December 31, 2020. Okay. So, we have, for this one, 2020, 140,000. So, we have to record our expense. So, debit. So, this is December 31, 2020. So, that is debit salaries expense and credit salaries payable of 140,000. Then we have for this one, we're not going to prepare an entry for this one anymore because it counterbalance already for this 100,000. Again, we're not going to prepare adjusting entry for this one because it counterbalance it already. Okay, also for this one, understatement of 2019, we're not going to prepare an adjusting entry for this anymore. Okay, and also for 120,000 for unearned or unrecorded interest receivable of 20,000. So that is this one, 20,000. So that is debit interest receivable of 20,000 and credit interest income of 20,000. And then for the equipment that were being sold in 2019. Okay. So we have again, this one is non-counterbalancing error. So we have to prepare an entry because it does not automatically correct the financial statement of 2020. So for the sale of equipment, so our entry, we have accumulated depreciation This was the entry, the net effect, or as far as 2019 FS is concerned. So we have accumulated depreciation. Again, how much is the accumulated depreciation? That is 240,000. But remember, December 31, 2019, they still prepare another entry for 60, another entry, debit depreciation expense 40,000 and credit accumulated depreciation 40,000. So this 240,000 becomes 280,000 already as of December 31, 2019. So debit accumulated depreciation 280,000. Then debit retained earnings, because that was a prior year retained earnings. For how much? That is, let us have credit equipment first. Credit equipment of 400,000. What is this retained earnings? The net of this one. Remember, the 220,000 were recorded as miscellaneous income, but they were not able to record the 60,000 sale on a gain on sale of fixed asset. So the net of this one is 120,000. So our entry, debit accumulated depreciation, debit retained earnings 120, and credit equipment of 400,000. Okay, to adjust this information, the errors of concerning this information. And we have for 2020, since the books are still open, we can still prepare an adjusting entry for the depreciation expense. So that is debit accumulated depreciation of 40,000 and credit depreciation expense of 40,000. Okay. If the books were already closed, it means that the books of 2020 were already closed. It means that we cannot use anymore our nominal accounts. So instead of nominal accounts, it will be retained earnings. So for this one, salaries expense, it will be debit retained earnings 140 and credit salaries payable 140,000. For this one, it will be debit interest receivable and credit retained earnings of 20,000. For this one, so it will be debit retained earnings, the total of this, debit retained earnings of 400,000 and credit equipment of 400,000. And debit accumulated depreciation 40,000 and credit retained earnings of 40,000. Again, because the books of 2020 were already closed. Okay? So, for follow-up video, part 2 of this topic, we're going to discuss another problem. Okay?